Welcome to Getting Real with Real Estate with Danielle Kempf and Jim Kempf, St. Louis's favorite father-daughter real estate team. Your source of real estate information in the greater St. Louis area.
All right, so I have a joke for the day.
You do?
I do.
Great. All right, what is it? Let's hear it.
Okay, so the loan officer approved my plan to go ahead and buy a horse farm.
Really? That's great news.
He said it was a stable investment.
Stable because of the horses. I get you.
You played that way too hard.
Oh, that's funny stuff there.
Is it?
Yeah.
Did you really find me funny? Would you give me candy out on Halloween if I said that?
That'd be a good Halloween joke. Yeah, sure.
You'd appreciate it.
Absolutely. I mean, nowadays kids don't. This is a total tangent, but
they don't
kids
tell
don't even
jokes.
tell jokes now.
I know.
I mean, goodness gracious.
They just want candy and they're leaving.
Back when I was a kid, I had to tell a joke or you didn't get nothing.
Same.
We put our candy in a pillow sack.
I think I actually had baskets. Anyway.
All right, so that's
What
really.
does a horse farm have to do with today's topic?
I don't know, but the candy topic really has nothing to do with our
Today's
podcast
topic?
today.
No. Do we just want to restart?
So the horse farm has, I don't know, what is it? Well, you said about financing,
Yeah.
right? The banker approved your
My horse farm loan.
horse farm loan. So I guess we're talking about financing today.
We are talking about financing.
Yeah.
Welcome to Financing 101.
101. Yep. This is just the kind of the high level, right? High level overview of kind of what you need to do, I guess, right?
And the differences between the
get a
different
loan.
loan products.
Yeah. Well, it's kind of important when you're buying a house.
It's, I would say, the first step when buying a house.
Most folks can't just reach in their pocket and right?
Write a check.
Write a check or pull out the cash for the house.
Anyone
so
out
you
there
gotta
who can,
finance
let
it.
me know. Give me a
Right.
call.
That'd be great, huh? Yeah. So obviously we have to, and we're not loan officers here, guys and gals, but
Do we play them on TV?
we could, I guess, but we have to talk about getting pre-approved, right?
Getting
And
pre-approved.
that's really the first step. We can't really do our job until our clients have that conversation with a mortgage advisor
Yeah.
and figure out how much they can finance, because it doesn't do us any good to I could show you $1 million house, but if you can't afford $1 million house, why, right?
We're just wasting everyone's
Just
time
wasting
then.
time. So,
yeah.
yeah.
So we just have to know that you can borrow the money and then we can get on to the fun stuff.
Yeah, absolutely. So what's it take to get a Danielle, what do you think? Like to get pre-qualified, pre-approved? Those are the terms that you're going to hear, right?
Yeah.
Basically.
So first you're going to do probably a uniform loan application. Well, I guess even before that, you're just going to have a conversation with the lender.
Yeah.
And then you can get pre-qualified that way.
Correct. Right. So that's just a quick probably conversation with a mortgage advisor, right? You're going to talk about, your assets, your debt, your income, that kind of stuff. But and they may do like a soft pull on your credit. I think that's what they do. Don't hold me to that. But, but it's just kind of a conversation, right? And based on what you tell them, they can say, hey, right,
Roughly you're around.
Yeah, if everything is as you said, you can finance up to X.
Yep.
Right? So that's kind of a pre-qualification.
And then the next step after that is actually submitting a loan application to get your pre-approval letter.
Yeah.
And so some of the things that they're going to ask for on that uniform loan application is going to be your name, your social security number, your marital status, employment history, income from other sources, if you have maybe child support or a pension or something like that. They're going to ask for like your bank accounts, your assets, 401ks, any liabilities, credit loans, student loans.
Yeah, just kind of all that information.
Yeah, they're going to ask for all that information. And then from there, they're going to do a harder pull.
Yeah, they'll run credit.
Yep.
And that's what they got to do to get you pre-approved. So, and that's obviously that's a better step, right?
Yep.
Pre-qualified's the kind of the low, if you will, right?
Yeah,
That's the lowest or first
lowest,
step.
Yep.
Pre-approval is a little next step up, right? Means that you've gone a little bit farther with that mortgage advisor.
And they're pretty much guaranteeing the money.
Yeah,
More or less.
you
It's
still gotta
dependent on
go
an
through-
appraisal and everything.
Yeah, right. And then the next, I guess, which some lenders do, some don't, but is to like pre-underwrite, right? To go through in the market we're in now, our buyers have to be ultra competitive, right? So what pre-underwriting is where they will take you essentially through the entire loan approval process. So you'll verify all your, submit all the documents that they need to verify your loan, make sure everything's good to go. The only thing then you're waiting on is which house you're going to buy.
Yep.
And getting it appraised, essentially.
Correct.
I mean, that's maybe a little bit simple, but that's
for the most part, that's all you're waiting on.
pretty much all you're waiting on, right? So you got to then find how. But what that helps you with, from the buyer's perspective, is your offer is going to look a little stronger,
Agreed.
right, than just somebody who sends a pre-qualification in with their
Yeah,
right with
absolutely.
their deal. So that can help you and be a little bit more competitive, right?
Agreed.
And that's kind of what it's all about in this market, especially.
Yeah.
Being competitive is kind of key because you want the house.
Because you want the house, and there's a lot of other people who want the same house too.
A lot of times, that's right. Absolutely. All right,
So-
cool.
So diving on in. So do we want to talk about loan products next?
Yeah, what are your kind of two options when you're, when you're talking about
Loan products.
with your loan mortgage advisor? What do you got?
Well, you have your fixed rate and your adjustable rate mortgage.
Yeah, right. So pretty simple, right? Fixed rate is just your
It
interest
sounds
rates.
exactly as it is.
Yeah, it's not rocket
Your
science.
rate
here.
is the same for the life of the loan. You have the peace of mind that your monthly payment is always going to be the same.
Yeah.
You can do the 15-year, 30-year. Some do a 20-year.
Some-
Oh, and I saw an article the other day.
Yeah.
Some lenders are offering a 40-year mortgage.
That has been honestly that's been around
It's
a
been
little
around?
bit, but I don't
See,
know
I don't think
anybody
that's a
ever
good
done it.
idea.
I think it's a horrible idea.
Okay.
I
As long
mean,
as
it's
we're on the same
almost
page about
that's
that.
almost like
Well, you're
like
paying that much more interest. You're paying 10 more years of interest on it.
Well, yeah, and it's almost like that's almost interest only because you pay down
Yeah.
so little principal. And who wants to pay a house for 40
years? I don't even want to pay one for 30 years.
Yeah, I don't
Anyway.
like that. But and so the other again, like Danielle mentioned, the adjustable rate mortgage. Those are, again, as they sound, the rate can adjust on you. So you may have a fixed term for, it could be 3 years, could be 5 years, but then as rates improve or get
Change.
worse, they change, either good or bad, your mortgage rate can change with
And
it.
adjust with that, yeah.
And so back in the day, pre, the recession, back in 08, 09, 10, around then, adjustable rate mortgages got people in a lot of trouble because, interest rates, when they start going up, pretty soon you might not be able to afford your house. So if they go up too fast, right, and that hurt a lot of people.
Yeah,
So
I can see that happening.
I would just suggest
especially
to folks,
like how last year rates jumped from 2% to or 3% to 6%.
yeah.
If you had an adjustable rate during that time, that could really hurt
so-
someone.
Yeah, so anybody that's on an adjustable rate mortgage has probably seen that
Seen some
happen
changes.
already, and they're gonna probably, well, hard to say. My crystal ball is no better than the next guy's, but
Yeah.
probably gonna keep going up, I would think. But
Maybe not.
maybe not. Yeah,
We'll talk about that a little bit further.
Right? Yeah, you got some information on that coming up. So, so that adjustable rate mortgage, but depending on your individual circumstance, can be a good idea because usually they start a little bit lower than the 30 years,
Yep.
and maybe if your plan is, hey, I'm only going to live here. Maybe I'm going. Maybe I'm in a job that I'm only going to be here
I
for 2 or 3
relocate
years.
often.
Yeah, like if I'm working here and I know in 2 years or 3 years I'm going to be relocated to my next position somewhere else, that can maybe save you some money for a while. And then that
Because your rate's
adjustment
locked
don't
in for
matter.
maybe 5 years, and you're only going to be there for 2 years or whatever it may
Yeah,
be.
something
so
like that.
You're
So you-
locked in.
Yeah, so you
for
take
some time.
advantage of that shorter term. So I mean, they can work for you. Again, that's just a discussion you want to have with your mortgage professional there, and make sure
And
that
your mortgage advisor
for
should
you.
be asking you questions like, what are your goals for the next 2-5 years? So they can help better,
yeah, great point.
like, help guide you into which one. Because if you're telling them up front, I'm only going to be here for 2 years, you really don't need a 30-year loan.
Not really.
But
I
anyway.
mean, wouldn't think.
You wouldn't
So-
think, but anyway, that's a conversation with your mortgage advisor.
Yeah, but that's a really good point. And you know what? One of these days here, we're gonna have we'll have a mortgage advisor come on the show, and
Yeah.
we'll talk about financing 202 maybe or whatever. Like you said, have
Yeah.
our next session on that, and they can answer a lot more questions about that. So
Absolutely.
that'd be kind of cool.
Okay.
So let's talk about then the loan types that you might be thinking about, right?
Okay.
As you're looking, for what fits your needs. So really kind of two different types, right? So the first one is the government-sponsored loans, right?
Yeah.
So those are things like FHA, VA, USDA. And essentially what those are is the government kind of guarantees those loans, right? Mm-hmm. So FHA, for example, you can buy your house with as little as 3.5% down, right? But you do pay a mortgage insurance premium that you have to pay on that loan, which is essentially insurance against you defaulting on your loan.
Yeah.
Right? That's kind of what it is. Mm-hmm. And then VA.
VA is for all the veterans out there, so thank you if you're listening.
Yeah, thank you for your service.
But so you can use that on, your single-family homes, condos. You can even use it on multifamily homes for the 2 to 4 unit complexes.
Yep.
There is no minimum score per the standards. However, most lenders will use one to determine the interest rate for you. But you can put nothing down. You don't need anything to put down. It's 100% backed, which is awesome.
Yep. And you don't have to pay mortgage insurance either,
exactly.
Right? So that's cool. Yeah, that's a great
a great option.
Yeah, absolutely. And then USDA,
not super common here in St. Louis.
No, not really.
Just because we're city.
Yeah, but if you get out, out a little ways, into some of the
more rural areas,
surrounding counties that we, Jefferson County, sometimes Franklin County, Warren County, out in some of the areas that it's kind of on the outskirts of where we service, but USDA is a good option there as well. So
for that one, you also don't have to put anything down.
Yeah, but you do pay. I think you do pay the mortgage insurance.
You do pay an annual mortgage insurance.
So those are some good options for you. Those are, again, things you'll talk about with your mortgage advisor. Conventional loans are another option that you might have, right?
Would you say they're the most common? Which one would you say is the most common in St. Louis, at least?
Well, I'd say
conventional. I'd say conventional.
Yeah, I think. I mean, if you kind of think back to some of the listings we've sold recently, that's probably we'll get more of those than I think. I guess. But it just depends, really. There are some differences in the rates that, at least recently, there have been that make like FHA a little bit more
cheaper.
A little cheaper than conventional. But those things change, guys. That's one thing too that I'm just going to mention on rates, and I guess we'll get there, but they change pretty rapidly.
Oh yeah.
I mean, I think we're going to talk a little more about that here in a minute, and I don't mean to jump around.
But they change.
They can change daily.
I was going to say they can change multiple times a day.
Right. So that's really something to consider. I mean, I think what happens, a lot of people when they're talking to like a mortgage person, and they'll quote a rate, they'll say, hey, they're 6.5, and then they go look for a home, and it's 2 weeks later or whatever, and then now all of a sudden it's
6.6 or
6.7, or 6.75, whatever, and they think they're getting taken, but they're really not. It's just that's a market fluctuation, that you really can't control.
No.
And, maybe that was a tangent as well, but I just thought I would throw it out there.
That's okay.
But anyway,
let's finish up on conventional rate.
Yeah.
Or loans.
So those are really just loans where the lender backs the loan. There's no government backing on those loans or whatever, right? So there's really two types of those. A lot of times they're a little bit more stringent on credit than the government-backed ones. But what two types you got there, D?
We have our conforming and non-conforming.
Yeah. Okay.
So your conforming are ones that they can be sold on the secondary market. So to your Mr. Cooper and what are some of the other mortgage servicers?
Big places like U.S. Bank Services and Wells Fargo Services loans, those kind of things. Big.
So conforming loans can get sold onto those secondary markets. Non-conforming cannot get sold on those markets. And non-conforming is where you have your jumbo and your bank statement loans. So your jumbo currently the jumbo limit is around $726,000.
So, yep, I believe that's correct. Yeah.
And then bank statement loans are just if you don't have
kind of what they like. If you have irregular income, maybe I guess. Yeah.
But not great credit or something like that.
Well, like I think self-employed can be, that can kind of help because they can just see how much money's coming in and out of your bank account.
Yeah.
Right? So they can kind of tell how much money you're making. I think, gig workers maybe might qualify into that
Yeah.
kind of category, right?
Like
Because-
1099 people.
Yeah, I think that those are kind of more along the lines of the folks that would probably be using those.
Okay.
But they would, not everybody has a W-2,
No.
right? I mean, I guess you got to file taxes. Everybody does that. Supposed to anyway.
I was going to say, does everybody?
But yeah, does everybody? I don't know. But yeah, I mean, those are just different, again, different types.
Of the
And again, we're just
conventional
doing a
loans.
kind of an overview
Real
here for
brief.
everybody. So,
Yeah.
don't get us on the details exactly. We're just trying to get you the idea of what your options, right, can be.
Mm-hmm. Yeah.
So, yeah, cool. All right. So that's good there.
And then I'll say one little thing on the rates before we dive into that. Jim was saying rates are going to change all the time. We have this fun little saying that's marry the house, date the rate.
Yep.
That dream home might only go for sale once every 8 years or whatever. You don't know when it's going to be on sale next time.
Yeah.
Marry the house, date the rate. You can always refinance down the line when loans or when prices get cheaper.
Things change.
Yeah.
Yeah, that's a really good point because it's hard to find the right perfect house.
It is, yeah.
I think we talked about that in some of our other shows,
Recent
but
episodes, yeah.
yeah, I mean when the right one comes around and it's one of those 8 or 9 out of 10s, right?
Yeah.
You need to
Take
jump
it.
on that, take it, and you can deal with the interest rate sometimes later, right? And it might not be next week, it might not be, it's probably not. It might be a couple years down the road.
Yeah.
But if the economy, things shift a little bit and rates go back down, guys, I don't think they're going to go down to 3s anymore. I mean, I don't see that coming.
I don't see that.
I don't think anybody does. But I think now they're kind of more like what they historically have
Been around mid-6s.
Yeah.
Yeah.
Right.
So if you're watching this on YouTube, we have a graph pulled up. If you're listening on podcast, we'll just kind of explain it. So the Fred, the St. Louis Fred, has a 30-year fixed rate mortgage average in the United States. So it's just a graph, and just be thankful we're not living in the 1983 because interest rate prices were, what would you say that is, around like 18%?
Yeah, they were.
18%. So when we're talking about our 6%
Yeah.
right now and you're thinking, oh my goodness, it's not
Right.
that 2% we saw anymore, just be glad it's not 18%.
Yeah, that was like 1982-ish, I think.
Yeah,
something like
1982, 83, right in the middle of there.
that. I was in high school.
I wasn't born yet.
Cardinals won the World Series in 1982. Just FYI.
Interest rates weren't that great.
I think it was 1982. I'm pretty sure.
Oh my
yeah.
gosh, we're tangenting.
Yeah, we are going on some tangents. But hey, if you're talking about the Cardinals winning the World Series, it doesn't matter. You can do that.
It's okay.
So,
But
so
then,
go
go
ahead.
ahead. No, you go.
Well, I was just gonna say, like, we've been talking about affordability a little bit, right, on houses, obviously with the rates as they increased last summer and fall, right? Everybody knows they went up dramatically,
Yeah,
right? We
doubled
all know
almost.
that. And really, October is kind of the peak month, and I think we'll probably have this slide
our
up too,
YouTube.
right, on our YouTube page. But basically, it talks about like average mortgage payments, what they were. And October really was the peak at $2,043 per month, right? So, and they actually have come down over November, December, and January. So they are, rates have settled down a little bit.
Yeah. They've definitely settled. We're not.
Yeah, I mean, I wouldn't call them low, but
No.
I mean, they are what they are.
And I feel like they're pretty stable right now.
it seems like it. I mean, to me, and again, I don't deal with them on a daily basis, but
Exactly.
they all
But
seem
from
like
what we
it's-
see.
Yeah, I think so too. I think they've been pretty, overall pretty stable.
Mm-hmm.
So, yeah, that's a good thing.
That's a good
That's
thing.
good
And
for all the
then they're
buyers.
projected, again, some people from who we're listening to, some of them project them to get a little bit lower. Again, not down to that 2%, 4%, but maybe mid-5s.
Yeah, I mean, that'd be nice.
That'd be really cool again.
Yeah, I mean, we looked at some information just today, Danielle did, and it shows, again, these are projections, right? So they can go any direction.
Yeah.
But, people are talking like in the 5s in 2024. Like Q1 24, they're projecting rates to be just a little bit over 5%. So
Yeah.
that would be great, right?
That'd
if
be
they get back to
awesome.
there. We'd love it, I know that, but
I think buyers will love it.
yeah.
But
and
I think also buyers are getting comfortable with what rates are at this point. We've been dealing, or
Again.
we've been seeing the average rates for a while now, for a few months.
Yeah, no, I agree. It's kind of stabilized.
Yeah.
And like you said, like we mentioned earlier, they've kind of come down just a touch, but like Danielle said, kind of more stable, which is a good thing.
Yeah.
You know, there's a lot of things going on in the world, right, that affects interest rates, and if some of that stuff, you know,
job reports, banks closing in California.
Yeah, Ukraine and OPEC.
Everything.
And there's so many things that go into
the butterfly effect.
Yeah, everything affects everything. But long story, I guess, short, is that, you know, it does sound like over the next year or so, rates ought to continue to maybe drop a little bit, right? Yeah. Maybe as much as a point from where they're at now, maybe even a little more, which is going to be great for our buyers.
Yep.
It's going to be great for really anybody looking. And
it just makes it more affordable for all the buyers out there.
Yeah, absolutely.
So,
absolutely.
Final graph, final talking point. We have this other graph pulled up, and it's mortgage payment to income ratio. And so typically people advise that your principal and interest payment should be about 25% of your income. And so like Jim was mentioning, when the rates peaked back in October, that ratio, that mortgage payment to income ratio, that was at 27.4%.
Yeah, it's getting high.
Nationally, that's pretty high. But again, now it's been dropping back down. As of, we're in April right now. April, it's about 24%, 23.8%. So it's just under that 25%. But I think with the interest rates, when they jump back up, they kind of, the affordability of buying a home kind of went out the window for a little bit. And now when it's coming, well, for some, exactly, depending on for first-time home buyers, I should say.
Yeah, because I think prices, well, you know, the house prices, you know,
they were going up, interest rates were going up.
Yeah, we still have this whole situation of lack of supply, right? So, you know, you got to pay top dollar plus on some cases for houses, plus the interest rate's now a little higher. So, yeah, that made that affordability, right, that made it tougher.
Agreed.
Just so that's why I think your number there jumped over that 27%. But that, like Danielle says, come back down a little bit. And I think it probably will continue to. I don't know if house prices are going to go back down, but they're not going down, I don't think.
No.
They're just going to kind of...
The appreciation is going to lessen.
Yeah, that's correct. So, anyway, long story short, good news for buyers.
Good news for buyers.
We think,
it's still a great time to buy.
Yeah, and if, you know, if all this interest rate talking and stuff... Again, it's very important to make sure you're talking with a good financial advisor or mortgage advisor, right?
Yep.
To get yourself ready to buy. So if you're thinking about it, or you know, I mean, even if it's a wish list, right? In the next couple years, I want to buy a house. Man, we'd love to just chat with you about what your plans are and how we can help you get ready to make
be in
that
the best
plan,
position for when you are ready.
Perfect, yeah, and make that plan a reality for you when your time's right. So, okay.
Alrighty.
What do you think?
I think that sounds good for today.
Alrighty, well, we'll see you guys later.
See ya. Bye.
You've been listening to Getting Real with Real Estate with the Kempf team. Have questions about real estate or something you'd like to discuss? Contact the Kempf team at 314-336-1926. Or visit our Facebook page at facebook.com/The Kempf Team. Don't want to miss any episodes? Follow us on your favorite podcast app or YouTube. The Kempf Team. Real, honest real estate.